Sarah, some really interesting forecasts here from our panel of 42 forecasters here. And there's an anomaly here I want to show you. Let's go and look at where the S&P forecast is. Back in December for 2016 and 17, looking for pretty robust numbers, 22.23 and 21.40 for 16. And then we had that big swoon in the middle of January there, and the numbers in the forecast came down for both years. Then they came back up, but almost in line with where they were, except for not this year, but more next year is where they get back. 3% and 9% are the expectations for the S&P for this year and for next year. But watch what happened to the bond forecast, or the outlook for the 10-year. Had been at 3%, came down with the when the market had that swoon. There was concern about recession, but it's come down again. I mean, it's kind of flat for 2017 at 283, but down again for this year, 2.34, currently trading right around just below the 2% level. So relative to this over here, where the outlook for stocks came back up, the outlook for bond yields did not. And I want to show you one more anomaly here, which is I like to think bond yields trade most on the inflation forecast, but watch what happens. Inflation forecast went up a little bit for this year, 1.5 to 1.7, and 2.1 to 2.2%. So that came up a little bit, and again, the outlook for bonds did not. Unclear who's going to win this. Our forecast for the Fed is for them not to do anything in the March meeting, but about 80% now see a rate hike in June or even earlier. Some are carving out April and May for the possibility. Stephen Stanley at Amherst Pierpont Security says the FOMC has been excessively sensitive to financial market swings and is falling increasingly behind the curve. Thomas Kostrick at Standard Charter says we do not think the Fed will hike rates this year. In fact, the next move may be a cut rather than a hike. In our view, that is one of the outliers right there. Carl, if you go online, CNBC.com, we have much more detail about this particular CNBC Fed survey.